Good evening. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for January 8th, 2011. We are in a bull quiet market with the annual RSI weekly just barely into overbought conditions, and the 10-day index at the high end of neutral at 75 out of 100. The percent stretch above the 200-day moving average and the slope of the 50-day moving average are both exceptionally strong. ADX 14 is at 31.7, so we're relatively high in the trendiness of SPY. The ATR percentage is at 0.68%, puts us in quiet mode, and you can see that it is hooked up slightly here. Looking historically, though, this is an exceptionally quiet market, even with the slight increase of volatility that we see in the first week of January. 63% of the time the market has been reversing the initial gap in the last 30 days. It's done that 19 out of 30 times, by which we mean it will gap down and then reverse to close higher for the day. And it's done that 26.7% of the time. And then 36.7% of the time it's gapped up and then reversed to close lower. Those are important numbers for us as we prepare our intraday tactics. The standard deviation of the morning gap remains at 0.75%. The average best intraday move remains at 2.38%. You can see, looking at the last 10 days of the 10-day index, that we've just now slightly pulled under overbought conditions. Pivot point remains at 127.02 for $4 north of the critical support level at 123. We have signals in the overreaction system for EFA and EPP, which is the Asia less Japan and then the Euro-Asia mix. And we have a channeling signal for EFA, again the Euro-Asia large cap mix. You can see ADX, which had been below 15, has now crested over 31. The sell-off of the last couple days has brought the plus DI down a little bit, and that's why we're seeing the ADX begin to roll over a little bit. This is normal behavior. When ADX gets north of 30, and it's already an exceptionally strong move. So a pullback here would not be unusual. 10-day max pain candidates: Travelers, Coke, McDonald's, Verizon, and Home Depot. And in the ETFs, India, which is by far the worst of the global sectors, gold miners, regional banks, South Africa, and Australia. Very few pattern trades out there for us, but 551 signals in DBA, which is the Deutsche Bank Agriculture, and then CVX Chevron. Triple screen signals in XLP, Home Depot, and AT&T. The Elder Safe Zone, signaling increasing weakness in emerging markets: Latin America, Chile, Cliffs Natural Resources, and Brazil. Inside the daily tactical, the percent winners: Merck, Pfizer, Exxonmobil, Boeing, and Chevron. Percent losers in Travelers, AT&T, JP Morgan, and Bank of America. I like the last two because they have been relatively strong, and we're going to see that financial sector has been excellent, and that's a buy on dip opportunity. Travelers, it may also be lining up. It's an oversold on 10-day and 3-day, and was a percent loser on Friday. Verizon is interesting to us because it's also a 10-day and a 3-day max pain, but was not a percent loser on Friday, and so the rebound may already start to occur. Inside the ETFs, you can see how many in the green here. 52-week index are still overbought. We've got gold and silver are in max pain conditions on 10-day, and silver especially setting up nicely. It's a 10-day, a 3-day max pain. It's oversold on a 10-day index and was a percent loser on Friday. Yes, silver is very volatile when it sells off, but it's already 8 to 10% off its recent swing high. Silver may be on sale. We will be careful about entering it. We'll wait to see a bottom being put in. But given the tragedies in Arizona, we may see a flight to quality on increasing uncertainty. And so silver remains an interesting one for us. Oops. Got ahead of myself here. Let's head back over to the Dow. Quite a few patterns in the doji pattern in the Dow, and a large number of channeling. Now, I like Home Depot for the following reason. It was oversold on 5 and 10 days, but not on 1 and 3 days. It was not a percent loser on Friday, but it formed a doji, has had an orderly pullback, and is firing on the channeling system. It also triggers the triple screen, and it's the number 2 candidate for max pain. So Home Depot's on my short list. Coca-Cola is another one, oversold on 5 and 10 days in 1 month. Was not oversold and was not a percent loser on Friday. It's number 1 position on our max pain range compression, and also fires on the channeling system. Travelers has got to be a little more cautious with. It's been oversold from 1 day all the way out to 1 month, and even though it's max pain range compression and a channeling, there may be some more losses ahead for Travelers. So we have to be a little more cautious on that one. On the ETF summary, only one doji formed in DBA, which was a 551W pattern, and the number 1 on our max pain range compression, so that's on the short list. I like oil here. It was sold on 3, 5, and 10 days in 1 month, but was flat on Friday. It's number 2 position on max pain range compression. That looks good. Silver, it's been terrific all last year. It's getting smashed pretty hard the last 10 days. As you can see, it's number 3 on our max pain range compression, and also signaled on the channeling. In the Elder Safe Zone calculation, we've got weakening signals in emerging markets, Latin America, Chile, and Cliffs Natural Resources. You can see how tightly price is clustered around the 30-day regression line channel. And you can start seeing some of the longer tails as it's starting to sell off. We're now 1.5 standard deviations above normal in the 200-day stretch percentage. That's as high as it's been in the last 6 months. A 5 to 8% pullback here would be absolutely normal and would still be considered noise. 30-day regression line slope is starting to roll over and just crossed its own 10-day moving average, 1 standard deviation above normal, and that's an indication of a potential turning point in the intermediate trend. No resistance overhead, however, on price, but you can see a little bit of weakness creeping into price. On the 30-day quality for the Dow, we're looking for, what I look for is horrible 2 months ago in the red, and then looking for yellow. So I like Boeing, which was horrible 2 months ago, now is only bad this month, and so it's actually starting to improve. I also, for that reason, like Pfizer and Cisco and Bank of America. I like Merck, Bank of America, and Pfizer because they were already percent winners on Friday, and all other things being equal, I would buy more of them going forward. Exxonmobil in the energy sector, you can see, has been green and green. In fact, it's gone from yellow on an annual look back to white on 3 months ago, and then green for the last 2 months. Very strong. That's where the current momentum is. You can also see Chevron is doing pretty well, but not as far advanced as ExxonMobil. You can see technology on the 30-day relative strength score is starting to pull away from the other U.S. Indices. It's almost 2 standard deviations better than the market. And so we should look to reward technology such as Hewlett-Packard has been strong all last week. I would buy more in there. Intel, if it can hold above 2075, has a potential for swinging back up to 22, but I would do that on a very careful basis. And that's the daily trading plan for Tortoise Capital. And wish you good trading. Keep your powder dry.